August the 11th, 2011, and I'm really not going to talk much about silver, rather that of gold volatility, so I'll start a little bit within the silver market. It is currently a little after 10. Silver is roughly around 38 and a quarter right now, and the more often you test support, the more likely it is that it gets violated, and that key level is roughly here at around 38. So we've had this test, 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 and when you're having the test on a support level, when you have a trend like this, it really doesn't look the greatest within the short term, as if this level really wants to hold. On the break of this level, I'd be looking to that 35 or so area, but when we look at this entire chart, I'm looking at three specific ranges. The first range is one in this area here. And for the most part, when you take a look at this, you can say, well, right now we're finding support on previous resistance. Right now, of course, that is the case. So that's one range. The second range is the more recent one, which is the one that we're currently in. And the entire one is this entire range that we are currently in. And a lot of times when you make a market, I don't know, there's no name for it. Maybe there is. I don't know what it is. It's when you make a big high and a big low. Therefore, you have a situation here where you make this big high and you make this big low. And since then, you've managed to get to the middle part of it. You've yet to violate either the low or the high. That's been the case. That's always indecision. What you can always do is draw in trend lines. And really, until one of them breaks through, then the technical analysis is really telling us that things are very neutral. Now, that's what the technical analysis says. You can say, well, that's all junk. We all know what's going on with the printing of the currencies and all this type of stuff. Okay, well, then you need to take a look at the technical analysis for something else, like money creation, and you'll be doing very fine. But this is it for silver for today. Now let's move on to gold. For this one, I want to start off and really only look for charts within the quarterly chart, each candle representing that of 3 months. Now, I don't know the best trend line to go through here, but it really seems as if we are really testing this area, and we've been holding some nice areas of support for the last 3 years or so, if not the entire 10-12 year period. Getting above this particular trend line can create a lot of extra volatility within the market because we're really not seeing that right now. And some people may tend to disagree, and that's fine, but the data that I'm looking at is not showing it. For example, if I were to take a trend line of this nature, this is a support line that lasted for the length of about a dozen years or so. This trend line, the best it's lasted for on here is roughly about the same, but at the same point you can see this trend line, it was bouncing above and below this level, where this one is just staying within it, not really going down or up all that big. As far as a trend line of this magnitude, I don't think we're really yet at that kind of level. We're doing that right now. So you can see we're matching this trend in here, and we can see here what happened when we broke this resistance line. Yeah, exactly. That's when the volatility kicks in. When you break resistance lines to the upside, that's parabolic. That increases the volatility. Now, as far as point A to point B, I consider this a point A, I consider this a point B. I consider this a newer point A, and we haven't finished point B yet. Point B here was $35 per ounce. This point in here, 800. The difference from 800 to 35 would work out to approximately around 23, just by doing the numbers quickly in my head. And from this point B of 250, just simply multiplying it by 20 brings us to the area of the $5,000 per ounce. Now, if we take a look at some previous days and where we are today, we are looking at the quarters in which the gold market gained at least that of 10%. Some numbers are in bold and some are not. The numbers that are in bold are quarters that did better than we are currently doing on with the current third quarter of 2011. In 1968, in the second quarter, gold gained 16%. Then again in 72, 33%, which is higher right now. You got 38, 36, and well, during the 1970s as well as 1968, there were 15 and 14 in the 70s that had at least a 10% move. And there have been 8 quarters that occurred then that has done better than we currently are on right now. This is the greatest quarter in gold's history. 54% in 1974. For us to surpass this mark, the price of gold would have to come close to around $2,300 per ounce by September 30th. Moving on to the 1980s, there were only 4 times when gold gained that of over 10%. 3 of the 4 times it was when at greater levels than we are at today, 22% in the 86 third quarter, but the levels were nowhere near because this was a bull market and this was a bear market. And the 90s were a bear market as well, only 4. And what this means is right now we are up 16.5% in 2011 Q3. This is the biggest quarter since 1986. So that's something to consider. But when I take a look at this data and look at this on a technical level, analyze this as much as I can, aka using technical analysis, what I've come across is that, if anything, this is really telling you that the breakout's really only beginning. Because for the first time, we are now approaching that of possibly getting a 20% gain, something that occurred on 3, 4, 5, 6, 7, 8, 9, 10. There have been 10 quarters since 1968 with a 20% gain, and the last one was 1986. Now, I want to finish this off by going over the best weekly increases for that of silver. I put this up a few months ago, and this really shows a similar sort of analyses, if you will, for since 1968, the best weeks that silver has ever endured takes us to 79, 87, again 79, 80, 98, 1980 times 3, 79, and 74. Therefore, within the top 10, the ones that would be reflected to the 1970s would be this, this, and this. All but 2 of them. They were the 1987 and 1998 that were not. The 1987 was in that bear market trying to get out of it, but obviously that failed, and well, as did this one at that time frame. And the analysis that this tells me is if you ever believe in anything to be that of overdue, well, this just might be one of them. Thank you for tuning in and take care. Bye bye.